Why do I think this is the bottom? Surely things are going to get worse before they get better. And that could always be the case, but I wanted to just weigh in today on a Friday before we go out and enjoy this beautiful fall weekend. Some things I've been watching and seeing if they can be a benefit to you. So we know we've got the Israeli Palestine war going on. We've got the pending government shutdown with our own brand of craziness here in the US. And of course, recession predictions swirling around and rising interest rates from the Federal Reserve as they try to battle inflation. So with all of that going on, I do wonder if this is the bottom. And I want to present three reasons why I think we are near or may have already bottomed. And let's start with one of my favorites. If you've been following me for the last few months, one of my favorite technical indicators is the fear greed index. So what I want to do here is pull out the fear greed index over the last 2 years, and this is going through October 19th. The October 20th is informative, but we'll save that for a different podcast or, video. So what I want to do is something I haven't done quite like this. I'm going to lay the S&P 500 chart over or above the fear greed index. And so with a little bit of juxtaposition, right here in this area right here, you can see where, basically these charts are almost identical. That's not really the purpose of what I'm doing here. And we'll talk about charts and indicators and predictions and things of that nature in this video. But what I did notice in my research over the last 2 years, just looking backwards, is that when we get to extreme fear, the market tends to have a bottom. So you see where we had the extreme fear here back in late October, back in last year, and then the market bottomed and started taking off. Not to say that's going to happen again, but that was something that was interesting. And I saw this pattern kind of repeat on the reverse side. When we reached extreme greed, the market tended to top, as it did in December of last year. And then you saw the pattern happen again in early January of this year. Market bottom, extreme fear, extreme greed, market top. And so, of course, right now, given everything that's going on, we are definitely at extreme fear. And so that is one of the reasons I think we may be at a market bottom. We reached extreme fear on October 3rd. The fear index went to 16. Anything below 50 is fear. Once we get south of 25 on the index, we get into the extreme fear. And our most recent peak for right now is holding steady at 16. So that's one of the reasons why I think we may be at a bottom. Now, looking at that chart, I want to make sure that we have some rules for looking at the market, looking at charts. These are just some of my rules. One of the things I always want to stress is the market is a mirage. What you see is not actually there. So when things are looking bad, they're actually starting to be good. Why is that? Because you're in this game to buy low and sell high. So bad equals good in the stock market if you are truly investing and not just trying to not lose money. If you're truly investing, you want the lowest prices possible, steady yourself and wait for the good times to return. So the market is a mirage when you think about it. Secondly, your feelings are false. Whatever you feel like doing in the market, do the opposite. So if you feel scared, you really should be getting greedy. You should be excited about things being cheap. And when things are feeling really good, you should be nervous because that means everybody's doing well, which means you should be rotating out of the market or rotating out of some investments or selling some things while the getting is getting good. And then what is real is relative in the market. And what I mean is, yes, the market may be down 10%, but it's relative to where it has been. So right now, the market is down roughly 9% from the beginning of August. And so it is down, but it is also true that the market is up for the year, roughly 10%. So real is always relative when it comes to the stock market, and particularly when it comes to your portfolio. So keep that in mind as we do these videos. I'm never trying to predict the market. And those are just some of my rules that I like to put in place. So we've looked at fear. Let's now look at the intraday low. So what I want to do here is go over to, you've been working with me for a while. I'm going to go over to TradingView. Always give a shout out to TradingView. I am not compensated by them. I don't even have a paid subscription, but I like their charts. They're very easy to use once you get the hang of it. And what I want to focus on is the intraday low. And one of the things that we look for when we are looking, when anybody is looking at charts, they're looking for patterns to be reinforced. So one of those is when the market reaches a low point. Does it hold that low point? So on October 3rd, the market reached a low point here. See if I can get this chart up a little bit. So right there, the market reached a low point. I'll get my pointer out here. Now, if you look closely enough, we violated that low point today. But that is if you look at the closing prices on the stock market. But there's always a price during the day that may be lower or higher than the stock market. And in this case, the intraday low for October 3rd is lower than the close for October 20th. So I'm gonna go over here and go to the S&P 500, and we're gonna look at the daily prices here. So here's what I'm getting at. You come over here and we get down to October 3rd. Let me get my pointer out here. Where did my pointer go? Okay, I'm starting to lose it. So here we have on October 3rd, 42.16 as our intraday low on October 3rd. Now, if you scroll up, let me get rid of that drawing, and look at October 20th, which was today, we closed at 4224. The low was 4223. So that is higher than 4216. So even though we closed lower than the October 3rd close, we did not violate that intraday low of 4216. Now, let's be frank. We could come out on Monday and we could violate that low. But for right now, this particular bottom is holding. And that's what you're looking for when you are dealing with the stock market and you're trying to look at patterns and stuff in the market. So this has happened before. It happens a lot when we're actually looking at markets. So here, back in April, when we were going through that regional banking crisis, we had a nice little pop, started to kind of get toppy here, and we went down, and then it held that bottom. So that's another place it did it. If you go back to October of last year, here we are here, same thing happened where we went down a lot here, tried to rally, and then came down and we hit that bottom right there. We tested it, but we didn't violate it. And that set up a move higher. And so when you're trying to determine, hey, are we getting the all clear in the market? You're looking for a situation like we have here where, okay, we're testing that bottom, hopefully, and we're holding it. And only time will tell what happens from here. All right, so let me go back over to the PowerPoint. All right, here we go. So we talked about the intraday low. Now let's get to the third bullet point that I'm looking for the bottom. And that is something that I found really interesting, which is the market technicality. That's what I'm going to call it. And it goes something like this. So this is a breakdown of the monthly returns for the year. And so, almost midway through the year, things were looking pretty decent. We did have that regional banking crisis, which is what you see here, where those regional banks, people were worried about their FDIC insurance. This represents right here all of the AI hype. Then we start hearing about FDIC here, and the market takes a dip. And then we also had that government shutdown that was averted. And so the market began to rise. And so that's kind of how the market was progressing and does pretty well in July. And then we get the credit downgrade in August. And of course, we start the rising interest rates again. We get into the international conflicts, government shutdown, just all types of craziness. And so that leaves the question, how will October end? And so I started doing some research on consecutive months with negative declines in the stock market. Now, I was just curious, all right, how many times does the market go down 3 months in a row? And just for context, when I'm talking about the market here, I'm talking about the S&P 500. You can pick the Dow Jones, Russell 2000, whatever you want to go with. I like the S&P 500, and I'm using the Vanguard 500 index just because it was easier to get the monthly returns. You know, the positive or negative is going to be the same minus a small expense. So what's going to happen in October? We're down August, we're down September. What happens when the market goes down 2 consecutive months? Do we get a third negative month automatically? So let's take a look. So again, we got the international conflicts, we got our own craziness, we got our interest rates, recession worries. So what's going to happen in the market? So what I did was I went back to February really of 1950. And I think in follow-up videos, I'm going to go back even further. I'm going to try to go back really to the 1920s to really give a comprehensive review of the modern stock market. But I felt like going back 1950, that's 73 years, that are 72 years almost. That should give us a pretty good idea of what's going on. So what I found was, how many times did we have 2 back-to-back months of declines in the stock market? So what I found was 31 times in 72 years. So really less than 50% of the calendar years that we have 2 negative back-to-back months of declines in the stock market, which I thought was pretty remarkable given that amount of time. We are talking about 644 months, which means you have at least 322 opportunities to have back-to-back declines if you take 644 and divide by 2. So to only have 31, that's pretty remarkable. It gets even better with the three months back-to-back. Only 17 times have we had 3 negative consecutive months of losses in the S&P 500 going back to February of 1950. So I know that we're running out of time in October, right? This video is being recorded on October 20th, 2023. That gives us, I think, 7 days left in the month of October to have a positive month. And given what's happened this week, all is looking bleak. So I did want to provide some further context and say, okay, what happens, when it goes down 3 consecutive months? How often do we have 4, 5, 6, 7, 8, 9? So I put a little chart together here. So we already talked about 31 and 17 for 3 consecutive negative months. How about 4? Well, turns out only 4 instances of consecutive back-to-back-to-back negative months in the stock market going back to 1970. 5, we only had 3 times. 6 months, 2 times. 7 months, 1 time. 8 months, 1 time. And then 9 months only happening 1 time. So where is this playing in the broader analysis of what we're doing? We're talking about reaching a bottom in the market. The market, even if it goes down this month, it's going to be hard pressed from a historical perspective to go down another month, which bodes well for our theory that we may be nearing a market bottom. If it does go down for the month of November, then to do month of December, you're talking, that'd be the 4th time that would have happened since 1970. so I feel like we're in pretty good historical odds that is not going to happen, that we are going to kind of reach a floor here and start rising higher. So don't worry about that. So is this the bottom? Well, given what I talked about, we talked about extreme fear, we talked about the intraday low holding, and then we talked about the how rare it is to have more than 2 or 3 negative back-to-back months in the market. But my answer is still maybe, and for good reason. Here's what needs to happen, in my opinion, for the market to bottom, for us to kind of move higher from here. The economy needs to continue cooling. It is cooling off, but the Fed wants to see more. The Fed wants those wages to kind of come in line. They want those jobless numbers to go up, ironically, to indicate that the higher interest rates are having an impact. And all of that, of course, helps to get inflation down. And in doing that, the Fed also wants, and we all want, we want to cool this economy off without triggering a recession. If we're going to have one, let's make it mild. And ideally, we want a soft landing, somewhere in the middle between no recession and mild recession. And so we may get that. Only time will tell. But we're definitely trying to slam on the brakes now and not, break anything or run into anything. And then finally, a functioning government, not to make this political, but a functioning government. Don't really care about the politics, what side anybody's on. I'm on no side, but just trying to get the country running, get decisions made. A functioning government would help to avoid the consistent worry of government shutdowns and interruptions in how things are going. So again, my name is Maurice Wilson. This has been another round of charts and numbers. Thank you for spending some time with me today. If you have any questions, feel free to email me. If you're not a client and you're listening to this, here's my minimum, here are my fees. Feel free to email me. And thank you for spending some time with me today. Enjoy your weekend. Thank you.